All right, guys, this is Matt. Matt, tell us about WT Capital. How long have you been doing this for, and what do you guys specialize in?
Yeah, for sure. No, so we've been, or WT Capital, simply put, we help anyone working in Australia full time that has PR or as a citizen acquire residential and commercial investment property using their self-managed super funds. So we've been
Yeah.
doing this specifically focusing on the SMSF sector since 2019. We're based in Sydney. We buy property all over Australia, as you know. And I think, yeah, all we're trying to do is really just map the whole process out step by step and effectively project manage everything, do all the heavy lifting for clients. We've got clients all over Australia. So our job is just to, yeah, obviously figure out what kind, based on, their needs, their goals and objectives, what kind of property is going to make the most sense. How do we, as with any investment, how do we make your money work a bit harder?
Yeah, absolutely love it. And when I was doing my research and came across you guys, that's exactly all your copy was saying the exact same thing. And I was like, right, this is something that I've wanted to do for such a long time, but it just seems like such a hard thing to go from like most people don't even think about their superannuation. It's just sitting there doing whatever. And then it's too late. By the time they get to retirement age, they're like, oh, I should have actually looked into this. So tell me, a lot of people are scared off by potentially even going into the wide world of like creating a self-managed super fund. Why do you think that is? And tell us about the actual process to do it, because I know from my experience working with you guys, it was the most easiest thing that I did. Most of it was done off my phone, which was a game changer.
Yeah, I think it's a good question. I think I mean, there's just been misconceptions, right? People think, oh, it's too hard, it's too expensive, I'm not smart enough, I don't, have an accountant. I think that the reality is with technology and how it's particularly.
Uh-oh. I cannot hear you. I don't know.
Sorry.
Oh, sorry, that might have been me actually. My Siri just decided to turn on. Oh, okay, yeah.
Probably.
You accidentally. Okay, I can hear you.
Sorry, where did you get up to?
I've got no idea. I was just like, oh, I can't hear you. It's like,
No, I think yeah. So it's just been a misconception for a long time. People think, oh, it's too hard, too expensive. The cost of it's come down so much now, and realistically, anyone who has a smartphone can set up and run an SMSF. In a couple of minutes, it's super easy. So I think yeah. People have just always thought, oh no, too complex, I don't understand it, too hard, I need an account, I need to do this, I need to print off 50 kilos of paper and sign all these documents, which is just not true anymore. And I mean, it is, I mean, it's just over 700,000 SMSFs in Australia, so a lot of people using them.
yeah.
And I think slowly, and we're certainly seeing now, I know all the big super funds, particularly the last couple of weeks have taken a bit of thrashing, so a lot more people are asking some harder questions of their funds now as well.
Yeah, oh, absolutely. Especially on COVID, everyone saw their super take a nosedive, yet property was still going up like that. So thank you for that. Tell me about how you view, like, what's the main difference between somebody actually taking control and having a self-managed super fund versus basically just letting it sit there. So give us some of the pros and cons to actually creating a self-managed super fund.
Yeah, absolutely. I suppose the biggest one is choice, right? Once you've got the SMSF as the trustee of the fund, I mean, you can choose. I mean, providing it's allowed under the ATO guidelines, which are still very broad. You can choose the appropriate investment for the fund. Obviously, we specialise in investment property, be that residential or commercial investment property. And as I said, we've got clients all over Australia. So they live in WA, they live in Brisbane, they live in Victoria. If they feel more comfortable owning a property in that state, then they've got the ability to use their super to buy an investment property in their respective state, or outside the state doesn't have to be. But yeah, I think that the number one advantage is just choice. You've got more control. You get to make a decision on where every single dollar goes, as opposed to a lot of the larger or the big sort of industry and retail funds now, where they're so big. It's hundreds of billions of dollars. Everything's a little bit convoluted, and I think a lot of people sort of scratch their heads and go, where did my money go? I don't really know where it is, and I don't really know what I'm paying fees for.
Oh God, yeah. And every month, like when I started getting serious about this and I was actually looking monthly into my account, I was like, what are these fees for? What the hell's this? when's my money, my apparent, investment money coming into my account? What's going on here? And they just hold it forever instead of a self-managed super fund where you can actually see it, growing as it's going, and then capital growth on the property. It's just phenomenal. Anyway, so tell me about some of a lot of people, since I started rabbiting on about this in my TikTok channel, a lot of people are going, yeah, but I can't do it because that I've got this, or I'm only earning this. So tell us some of the biggest myths that you help people overcome with this one, especially like how much money they need and how many people could be in a super account. That's a big one I've found.
Yeah, absolutely. Again, misconception, and this was, I suppose, just guidance that ASIC had released. I think the first time they sort of released guidance on this was back in 2008. Like, oh, you need, at least $500,000 to have an SMSF or establish an SMSF. The way they calculated that, it was purely off the estimated running costs of the fund. So there is no rule on how much super you need. ASIC's guidance was like, well, you're going to pay, they were working off, I think, just over $8,000 a year in running costs, which is obscene.
Yeah.
And obviously, you need to be generating a significant return to take into account, $8,500 of running costs and still make money and for it to be viable. And as I alluded to before, the accounting technology has just improved so much, which has meant that, accountants all over Australia can run self-managed super funds for far cheaper now. So there's not as much pressure. And I mean, there's literally no minimum balance. Obviously, if you have a lower balance, you need to go, hey, we're paying $1,500 a year, for tax returns and audits and all that kind of stuff. We need to be making more than that. It still needs to make sense. But that's probably the big misconception. People say, oh, I only got a couple $100,000, I don't have $500,000, so I can't do anything. Which is not true. We've got, a lot of clients that might have 200K, they might have 150K, they still buy a property. I mean, look at, some of the deals we purchased in Perth back in 2023, they're buying a property for 400K, 20% deposits, 80 grand, bit of stamp duty, you got 100 grand in a deal. The same property now is selling for 600, 650. So effectively, they've been able to double what they had in super, just in a couple of years. And for a lot of people who'd spent, maybe 20 or 30 years in the workforce, I think it was a big paradigm shift. They're like, oh, wow, I've effectively been able to produce the same result in, the 10th or 15th time.
Yeah, 100%. That's what got me when I bought this house in Perth. And then 5 months later, it got revalued at 150K more. I was like, what? I was like, I've had my super account since I was 15 years old, and I've got 160,000 in there after all these years. So yeah, that was a catalyst to go, nope, I'm not doing this anymore. So yeah, 100%. Tell us about as well, right? So like obviously the age, the super amount, merging superannuation accounts into the trust. And wages, what people have to be earning, and the stipulations, I guess.
Yeah, absolutely. So with respect to the actual structure itself, the SMSF, so you can actually have up to 6 members in the self-managed super fund now. It previously was maximum 4, but they increased that to 6, which is, we've certainly got a lot of clients, they use it as a family vehicle for generating wealth, it's parents and their children. Obviously a great tool for sort of the transfer of wealth as well. You can, I think another misconception is if you choose to sort of set up an SMSF, you don't have to roll all your super into it. A lot of clients go, hey, look, I'm happy with my current fund, but we've got an owner-occupied property and that's done really well. We'd like to replicate that, in the super environment, which is obviously far lower tax rate. So, husband and wife, they might roll 100 grand each in, and then they go buy an investment property. So you can still have the best of both worlds. So you can, and you can choose, if you have your employer contributions, you can either direct them, into your, you've got a tenant with CBUS or, Australian Super, or you can choose to have them go into the self-managed super fund. With respect to income, that's more so just from a borrowing standpoint. So if you're looking at acquiring a property with a mortgage, obviously that means we have to go to the lender and obtain sort of the finance pre-approval and then formal approval and settle the property. So it's just a case of how much you want to borrow. But I mean, typically speaking, you're on at least 90K a year. You're going to have not really any issues obtaining the credit. Not going to have any issues there. Finance pre-approval, and then obviously formal approval and settling a property mortgage.
Yeah, awesome. And just go back to this. So they need to be working in Australia currently. Do they need to be a resident, or how does that work?
Yeah, look, so if you've got PR, or obviously if you're a citizen and you're working, I mean full time, even part time is fine. That's fine. So, but yeah, they're the two main ones are obviously having residency or citizenship. Just from and that's again from the sort of lender standpoint.
Yeah. And with that as well, I believe there's a lot of things that you can do. Let's say if you're a couple and the wife's staying at home looking after the kid and the husband's on a massive salary, there's a couple of like really key benefits to that, isn't there? Like creating the trust and the super fund under the trust. Could you elaborate on that?
Yeah, 100%. Yeah. So I think, again, the primary motivation for most people to do anything in super, particularly in SMSF, is a tax advantage, right? So you've got, you can put more money in and pay less tax on the money that goes in, and there's a bit more flexibility as well. With respect, if you've got a partner that's not working, then you can look to sort of maximize contributions. For it's per year, whether it's a self-managed super fund or it's an industry or retail super fund, $30,000 concessional contributions per year. So that amount is taxed at the lower tax rate of 15%. And again, if you've got a wife who's not working, or a husband who's not working, whatever it is, then you've got two caps that you can sort of maximize there, which is obviously a big tax saving, particularly if you're paying 45% tax. If someone, do you want to pay 45 or 15, you're going to take 15 every day of the week.
Yeah. Oh God. Yeah. 100%. And tell me, with the upcoming election, do you think that's going to have any sort of, sway on what's going to happen when it comes to superannuation in general, and especially self-managed super funds?
I mean, anyone's guess, but I mean, I think not. I mean, specifically, looking at SMSFs and property, as virtually anyone who has a TV is aware at the moment, there's a rental crisis. There's not enough property in Australia, and that's why we've got ultra low vacancy rates and rents have been rising, drastically across virtually all states. I think it'd be political suicide to. I mean, if you just said no, you can't buy property SMSFs anymore, then you're taking a lot of rental properties out of the rental pool. I mean, again, no one knows, but you have to think that'd be political suicide.
Yeah, one would think. And tell us about the cost to set this up. A lot of people are like, it's like 50 grand to set it up. And it's like, no, it's not. So tell us about like the process and the costs to actually get a self-managed super fund up and running and with a property in it.
Yeah, good question. So yeah, there's if you think about it, there's two components. So the first component is actually setting up the self-managed super fund, which is just a form of trust. And then you can either choose to be an individual trustee, or you can have a corporate trustee company which you're the director of, or yourself and partner director of, or whatever it is. If we're acquiring property and we're using a loan, then we need to have the corporate trustee structure for the SMSF. So we set up one trust and then the corporate trustee company. And then because in the self-managed super fund environment, the loan type, or the type of loan that we use is an LRBA, or a limited recourse borrowing arrangement. Obviously, we need to then put the property inside another trust. It's called a bare trust. That sits inside the self-managed super fund, and that would also have a bare trustee company, which you'd be the director of. So, two trustee companies, two trusts, 4,400, no upfront fees. It's deducted from super when it rolls over, so literally doesn't cost you a cent out of your pocket. And this is most accounting firms. They're sort of just they'll set it up, they'll front all the asset and lawyers charges, and they just invoice the fund once the funds have rolled over into the new SMSF bank account.
Yeah, awesome. And it's such a seamless process. What we just went through, what you guys just did with me, and then like, oh, by the way, here's a property that's off market. Tell people about that, because I think that is an untapped resource that people might not even be considering, but they need to, especially if they're contemplating growing their self-managed super fund really, really fast with off-market properties that are way below market. So tell us about how you guys actually get these properties.
Yeah, 100%. Like, I think it's nothing magical. I think it's, we as a business, we purchase, relatively good volume, and as any business that buys a lot of anything, people want to deal with you, agents want to deal with us. I mean, agents, they want to get paid as quickly as possible, and that requires, a contract to go through smoothly, no hiccups, and the property to settle. A lot of the properties that we look at, if they have a tenant in them, they might be a bit harder to schedule open homes and things like that, and we might just have a crack at them off market. So we every day we get sent a lot of off market properties all throughout Australia. 90% of them are crap or overpriced, but 10% are really good, and we sort of make some money as we did for you, on the way into the deal, and that's the objective. Is just working really hard to make a bit of money on the way in. If we can create some equity by negotiating really well and identifying value in the marketplace. That's if it's 10 grand, if it's 50 grand, that's money that it's money for jam. As soon as settlement is affected, that's basically equity that we've created in the fund. So yeah, for us it's just reviewing lots of stuff. All the agents we work with, we do all the heavy lifting. We want to make the transaction as seamless as possible, and when we do that, there's minimal intervention on their part, which they like. So in turn, they send us deals before they go onto the market. Again, some vendors are always going to choose to list. Naturally, as a seller, you want as much competition for your property as possible. That's how you achieve the highest price. But a lot of things come across our desk every single day. They're off market, and we're routinely buying them for less than what they're worth.
Yeah. Oh, perfect. That was awesome. When you were just like, hey, what about this one? What about this one? I was like, sweet. So tell us then, what markets are absolutely pumping at the moment?
Yeah, good question. Look, in summary, there's quite a few, and I think that's been driven by obviously the last 2 years. We've had a lot of migration, a lot of people moving to Australia, and the second part to contribute to that is that just in terms of new builds, like our building supply or resupply has been really slow on the back of the sort of COVID recovery. A lot of builders and developers went under. Obviously, the cost of building went up. And I think there was a little bit more fear in the marketplace, particularly rising into rates where the interest rates were where they were. A little bit more fear there, so people were a little bit more reluctant to maybe build that new home. And that coupled with the influx of migrants into Australia just would put immense pressure on the housing market. So we're seeing literally multiple locations across Australia boom. Perth has done virtually everywhere in WA has done considerably well. For the past couple of years. Back in 22, 23, we purchased a lot of property in Perth. We still purchase there when we can purchase off market. At the moment, we're seeing central and northern Queensland doing really well. Mackay, Townsville, Gladstone, Rockhampton, all, virtually every suburb, double-digit returns. Some pockets in Brisbane, obviously, they've got the Olympics in 2032, massive public infrastructure pipeline there. So there is some opportunity. Rental yields a little bit lower. Adelaide, there's some awesome opportunity there as well. New South Wales is not that much on offer, a bit of a boring market at the moment and overpriced. Victoria, economically, has been thrashed, for the last 4 or 5 years, and it's not looking that promising for the next couple of years, but there are some value opportunities there. So if you want to buy, and buy with a pretty big discount, and you're prepared to sort of ride out, a bit of a patchy and rough bit for the next couple of years, there's some good opportunity there. So there's so many markets across Australia that are offering, really good value and really good rental returns.
Yeah, amazing. And if you're watching this right now, up in my stand store, there's a free ebook that you can download to get to the WT Capital guys. Go up there, it's free. It walks you through the process to get a self-managed super fund. And you can also get in contact with Matt and the team, and they can actually just walk you through it, have a chat, see whether it's right for you. And then, especially if you're in Australia, I will just chuck that out there now. Matt, I'm just going to go to this enormous list of questions that people have been chucking at me. And I'm like, I don't know. But yeah, let's have a look here. So I've gone through the primary benefits, and we've gone. Tell us a couple more misconceptions about people having, and the complexity. People think that it's so hard to manage their own self-managed super fund. In reality, what do they actually have to do, to manage it?
Yeah, so really good question, and I think the purpose of working with a financial planner and accounting team is the actual day-to-day running of the SMSF is sort of taken care of. The financial planner and the accountants and the auditor of the fund are there to make sure that everything we do, falls under the ATO's guidelines and the fund is being run correctly. And again, using property as a specific example, we do all the legwork. You'll find the property there, make sure the property settles. Find the real estate agent who's going to manage it, place the tenant. So once the tenant's moved in, normally it's fortnightly, sometimes monthly, but every fortnight you're getting your rental payments, go straight into the self-managed super bank account. The mortgage repayments direct debit out. Generally speaking, your employer contributions are going straight in there. Your property manager's paying for your council rates and water rates, whatever else. Really, all you need to do is, at the end of the financial year, the accountants will prepare all the financial statements and the draft fund returns, booking a meeting, so financial planner and accountants there, preparing everything. Once that gets ticked off, send it to the auditor. Auditor, we do all the legwork there, liaise with the auditor directly, auditor ticks it off, and it gets the tax lodged with the ATO. That's really all it is. It's one meeting a year for half an hour. So.
Yeah. Could that be any easier? Probably not. Okay, perfect. And how do regulations and compliance requirements impact self-managed super fund trustees, and what should they be mindful of? I hope that makes sense.
Yeah, look, I think it's and again, it's just making sure there are fairly strict requirements there, and it's largely just to make sure trustees or any self-managed super fund trustee is that the funds are there for their retirement, to provide in their retirement. So it's making sure they're doing the right thing. Only buying investments. The investments are assets of the fund, and obviously that's audited. So yeah, that's the biggest one, is just making sure that everything's done correctly. We have the right paperwork and documents for everything, and obviously provide that to the auditor at the end of the financial year. They tick that off. But yeah, it's just a process, just making sure that you cross all the T's and dot all the I's, which our accounting and financial planning team will do for our clients anyway.
Yeah, and that's what I love about you guys. It's literally hey, this is what I want to do. Then you guys are like, cool, we'll take it from here, and then just sending documents. Hey, can you sign this? Hey, are you happy with this property? Here's a property manager if you want to go through them. It was just so ridiculously easy. So that's what I'm telling everyone. I'm like, to my 18-year-old niece, or 20-year-old, should I say? I'm like, save up money, put money on salary sacrifice, get your super up, and bang. It's just going to set you up for life. So I'm like your biggest fan now, forever. I would just say that. And tell me, what are some of the misconceptions that people have about having a self-managed super fund, along the lines of, I can pull it out earlier. They still have to wait till retirement age, right?
Yeah, exactly right. Yeah. So it is, in the same way that, if you're, under the age of 60, or you haven't met a specific condition of release, it's got, if it's in a normal fund, it's got to stay there until you retire. So, or meet a condition of release. Yep. So, same in the same way that would occur. Same with the SMSF. We buy a rental property. We've got rent coming in every week. It's going into the fund. That rental income is an asset of the fund. So yeah, we can't touch that. So yeah, what we're going to do is, once we've got that environment or that structure set up, we just want to put as many good quality assets in that environment as we can.
Yeah. And what about, right, somebody comes over, like one of my mates was asking me this the other day. So they come over, they set it up in Australia, and then they move back to New Zealand. How does that work?
Yeah, so it's a really good question. We've had this, we've got a lot of Kiwi clients, so it's common. What we do there is we work with our Scott, our financial planner. We'll organise power of attorney. So obviously, under the SIS Act, which is a piece of legislation sort of governs what we can and can't do in the super sector, at least one of the trustees has to be in Australia. But we've got the financial planner there, power of attorney. The fund can still be run in a compliant manner, whilst we've got, someone who's overseas, whether it's temporarily or, semi-permanently, we can work with that and still make sure everything's being done in a compliant manner.
Yeah, perfect. Thank you so much. I'll get the snippet of that bit, and here you go, because I don't know. Yeah, awesome. So, all right, look, this is pretty straight. We're smashing through this list here. Guys, thank you so much for joining. If you're joining me, I'm Alana from Win-Win. As you know, this is Matt from WT Capital, and we're talking about how you can build up your retirement faster than any other way that I've ever seen. And instead of your super sitting there doing nothing, you can actually create a self-managed super fund. It's way easier than what you think, unless you're super lazy. This is one thing I've just recently done with the team, should I say, and I wish I would have done it years ago. So especially if you're a fly in, fly out worker, right, there is a free ebook up in my stand store. Go and download it. You can have a chat to Matt and his team and work out whether this is right for you. And I guarantee you would, especially with the property market, it's just mental at the moment. Matt, any property market predictions?
I hate to get them wrong. Look, I think, based on all the data that we're seeing and certainly what we're feeling in the market, and again, this bit of an aside, but as buyers agents, we're missing out. We're submitting offers and we're missing out on so many deals at the moment. There's so much competition. Obviously, our job is to try and buy the property for the lowest price possible, and the agent's trying to sell it for the highest price possible. So invariably, we're always going to miss out on some deals. But I think, we're really saying, I mean, this year there's just like a huge amount of just like speed in both the Townsville and Mackay markets. I mean, vacancy in Mackay is 0.7%, which is just wild. Literally the deals, the good deals on the market, they'll have, normally in excess of 10 offers on them, within 24 hours before there's even an open home. So, I think there's some of those Northern Queensland markets will have a massive year this year. I think, Adelaide will still have a really strong year. I think Perth will still have a good year, but it'll start to slow. We're already seeing, some, we get emails when there's price reductions. So I think, it's starting to slow a little bit in particularly some of those areas that went a bit hard. I think overall it'll be a pretty positive year for a lot of markets in Australia. And if they cut rates further, that's only going to increase demand, for good quality property as well.
Yeah, definitely. Did you say the Perth market is slowing right now?
It's starting to. It'll still, and again, this is compared to the last, 2 years of like 30% median house price. That's what, it's not sustainable. You can't have markets that are growing 30% every year. So, I think, Perth, again, no one has a crystal ball, but I think, when we get to December, it'll probably be across the median house price of all of Perth. I reckon it'll probably appreciate maybe 10%, maybe 12%. Which is still double digit. That's an awesome return. So I think it'll do well, but compared to the last 2 years, I think we're starting to see it sort of slow off, which is normal. We're seeing particularly in virtually everywhere in Perth, but some of the stuff we've seen, properties that were 2 years ago, or 2.5 years ago, they were 400 or 450, are now being put on the market at like 750, 800. There's only so much more in the next 1 or 2 years that can grow before it starts to just flatten off a bit. So I think we're in that a little bit, which was always going to be the case in any event.
Yeah, it's pretty scary for people wanting to get into the market at the moment. Like even this house that I bought in, that we bought in 2023 in in December, it just went boom. And then even after we bought it, the real estate agent came back to us and said, somebody came in after we'd accepted the offer, 30K over your offer. I was like, what the hell? It's just mental. So I'm kind of hoping that it does slow down a little bit so that, people like, the youth of today can actually get their foot in the door, because it's almost turning out to be impossible for people to buy houses these days unless you've got generational wealth or you're doing it the smart way through a self-managed super fund. So, yeah.
Super tough. Really hard to get in. And, I mean, the first property is always the hardest, right? Once you've got, as I say, once you've got your foot in the door, and really, once you've got a property there, you never be able to outsay the speed at which the property market appreciates. So, it's about effectively using leverage. So, once you've got an asset that's doing all the hard work for you, and again, if it's outside of super, you've got the ability to tap into equity, and obviously that's how you finance subsequent acquisitions in your portfolio. The first one, particularly for young owner occupiers, is pretty tough at the moment.
Yeah, oh, definitely. And what advice would you give somebody considering switching from a traditional super fund to a self-managed super fund?
Yeah, so I suppose that'd be again, the way we work, sort of everything's tailored for each individual client, based on their needs. But I think it'd just be consideration to the this is particularly relevant for clients who they've maybe got an owner occupied property or they've got an investment property. 9 times out of 10 they've seen the results that they've had there, and simply just replicating that. You've got this big chunk of money sitting in super. Most cases you can make that work a bit harder. And again, it's not because property is magical by any means. It's just because it's it's an investment where we can go, hey, we go to the bank, we've got good credit, everything's set up properly. We go, hey, this is a $600,000 property. We've got a 20% deposit. Can you lend us the rest? And they'll say yes. And obviously, when that $600,000 asset grows, we're entitled to 100% of the growth, not just the money we put into it. It'd just be something to consider. And I think for a lot of people, as you sort of touched on before, not many people sort of spend time thinking, hey, how long do I want to work for? When I do retire, how much money do I need to live off per year? And am I right now, like what I need to get me there at that time? And, 95% of the time people are not doing it. I think it's just been this thing in Australia where no one really thinks about retirement, until 6 months before they want to retire.
Yeah, absolutely. I was watching the news last night and they were saying about how the aged pension is going up $4.70 a fortnight. I was like, oh my God. And the lady's like, that's like a cup of coffee. And it's like, and you're saying that's a good thing. That is horrendous that in the lucky country, like the aged pension's going up to 1,100 and whatever it was per fortnight. How the hell, or something like that. Yeah, how the hell could anyone actually live on this? So yeah, we've got to, yeah, sorry, go.
I think it's not a good strategy to rely on the age pension. I think people have to be a little bit more proactive. It's just, and again, that will taper off. Obviously, with inflation, it's going to be hard to keep up with inflation. So, yeah, I think people, even even though they don't do something, people are going to be served well to even contemplate or just spend half an hour or an hour thinking about how long we're working for, how long we got left, what do we need to do, what do we need to live off. And I think even just going through that process, people are like, oh, wow, we probably need to take some more proactive action there.
Yeah, and that's it. People just don't think about it. It's just like, over there. I know my employer's like putting money somewhere for me, but I don't look at my super account. And that's what I was not doing until I did. And then I was like, what? So yeah, it's like you say, 20 minutes, have a look at what your options could be, as opposed to just doing nothing and hoping that your employer's doing the best, doing the right thing by you for your retirement, which honestly, they're probably not. So yeah, they don't care. Their super funds make $1 billion profits every year, and it's not because they're doing the best thing by their, their clients, I guess. Anyway, that's just me rambling. We've got Janelle here, who's asked, how much do you need in super to invest in property? Matt?
Yeah, good question. So again, sort of dependent on the purchase price, the loan to value ratio. But I mean, if you've got, if you want to buy something that's, sort of modest, good rental yields, in a growth location, I mean, even with 150K, you can get into the market, still leave some cash there. So yeah, it's considerably less than people initially think. And again, as the purchase price increases, the deposit increases. So yeah, what we sort of work with our clients doing is looking at where they're at now, how much we'd like to put in, how much we have in the bank. And again, based on where they are, is there any particular locations that are more interest to them? And just work backwards and figure out, what we can do.
Yeah. And when I know from personal experience going through this with you guys, we pulled the majority of the money out of my super fund to put it into my self-managed fund, and then kept a tiny bit in my original super account. Tell me the mentality behind that, and are we just a bit of security, or what's the go with that?
Yeah, good question. Again, it's generally speaking, people, if they've got their life insurance, their TPD. More often than not, we see that they're happy with the coverage, the premiums, they're pretty well priced. Those policies they're getting out of those funds. So if they're happy with that, they're happy with the cover. Then they want to make sure you sort of take advantage of that pricing and leave some money in there. So you've got some cover there. The clients we work with, they might leave a more substantial amount in there. And they might want to have exposure to a couple of different asset classes, obviously residential and commercial property, and then I suppose the broader superannuation market, through their industry retail fund. So again, it's very flexible, and it's based on the needs of each client and ideally what they'd like to do.
Yeah, perfect. Guys, thanks for joining this live today, whether you're watching the replay in the TikTok or the YouTube channel or the Facebook group or wherever. Make sure that you're following WT Capital. This is Matt, and he specialises in helping especially fly and fly out workers and people in Australia take full control of their superannuation and actually invest it in property. So instead of having it just sit there doing nothing, it's actually going to build up way, way, way faster. And this is something that I've just done, and that's why I cannot speak more highly about these guys. So yeah, follow Matt or WT Capital, follow me, obviously, and thanks for joining. If you've got any questions, chuck it in the comment section below, and we'll endeavour to answer them. Thank you. What about those with experience? Oh, sorry, we're not talking FIFO questions yet. I might stay on for another half hour after this. We're just going to keep going through all these questions that you guys have sent through anyway. Okay, we've gone through that one. How can self-managed super fund trustees ensure they're making informed investment decisions within their fund?
Yeah. Again, and this is, I mean, there's like I said before, there's a very broad list of sort of investments that the trustee can make. So the first step is just the awareness of that, what can and can't be done. And then I
Yep.
think the second part is really just get guidance from a really good financial planner and accountant. I suppose using both of them in conjunction. And I think for us, when we're working with clients, having an annual review, how is everything performing? Again, we're sort of assisting the planner, sort of assisting on the setup. So everything we are looking at is going to be a compliant investment. But the second part is making sure that we're reviewing that very regularly. Obviously, the fund's investment strategy needs to be updated on an annual basis as well. So we'll review that. So it's just having a process around that of revisiting, making sure everything is doing what it should do, making sure it's compliant, and consistency around that. A lot of people, I mean, this is not specific to super, just any asset, people buy a property or they buy an investment, and, have a look at it, and then they sort of just let it do its thing, and there's no real process, documented process going back, valuing it, reviewing the lease, reviewing everything else, and how do we optimize it. And I think it's that pattern of optimization every single year, even if it's 3%, 5%, 7%, compounded over 10 years, that makes such a massive difference to someone's retirement.
God, yeah. Especially considering what super funds are doing at the moment, which is not very good, quite frankly. Okay, and
That's
this
like,
one's yeah. I'll tell me about it. This one's kind of almost a continuation on from that one. So, what resources or strategies do you recommend for individuals to stay updated on self-managed super fund regulations and best practices?
say again, sorry, what resources?
Yeah, what resources or strategies do you recommend for individuals to stay updated on self-managed super fund regulations and practices?
Yeah, look, I think you shouldn't really have if you have like a good team, if you have a good planner and a good accountant. I mean, it's not something for like you shouldn't have to be reading thousands of pages every year. Obviously, it's the accountant's job, the planner's job. Obviously, the auditor's there. The auditor has to be an ATM approved auditor. They'll make sure, and again, as regulation changes, and sometimes it's a fluid environment. They'll make sure that
Yeah.
the fund is being run in a compliant manner. We need to make adjustments. We'll make adjustments. So yeah, look, if people just want more exposure, they want to learn some stuff. I mean, there's some awesome free like SMSF trustee courses out there online that you can do that. So there's a massive amount of information. People can either do courses. There's blogs. There's YouTube channels. So there's a huge amount of sort of resources that are available for free for anyone who wants to learn more. But I think when it comes to the running of the fund, if you're going to pay someone to run it, you really want to offload that work to them. That's what you're paying them for.
Yeah, I know when I had that question come through, I'm like, what? Why would you even want to do that? I'm like, if you have a good team, you trust your team. To me, I'm like, here you go. That's what you guys handle that. I'll do what I do. You guys do what you do. So yeah, yeah, 100%. And tell me, okay, so what's the somebody gets to retirement age, they've got however many properties in their self-managed super fund. What is the process for then going like the exit strategy? I guess of yeah.
Yeah, good question. And again, so there's like a few different variables there. I think that would really, again, there might be, if it's just one member, it might be a couple, it might be multiple members. So yeah, I think part of what we do with clients, we'd have, our planner sort of sit down, and again, many, many years before they even retire, sort of map out that strategy. But if someone was coming up for retirement, we've got that strategy been clearly mapped out. It'd be going, hey, we've got all these assets here. Are we selling one? Are we selling them all? What are we doing? How are we just switching out to like a pension income stream? So it's just mapping that out. Obviously, there are some tax benefits. If we wait till we retire to sell any assets in the super fund, then we negate any capital gains tax, which is an amazing hack for anyone. So we
Yeah.
want to be conscious that if we are selling assets or we're contemplating selling assets, can we do that after retirement, and then obviously avoid having to pay CGT. And then once we've sold those assets, what's the strategy then? Is it, are we drawing out an income stream every week, every month, whatever it is? So yeah, again, we've got sort of planners in-house, so we document that, map that out, provide advice on that, because obviously that needs to be tailored to each individual's sort of circumstances.
Yeah, awesome answer. Thank you. And that one, somebody was like, yeah, but the tax is so much more when you retire and you pull it, you liquidate the fund. And it's like, oh, calm down, mate. You're not going to have if you've got 20 properties, just sell them all at once. So tell us about the capital. Can you just elaborate on the retirement and the capital gains tax situation?
Yeah, absolutely. Yeah, and again, probably something that's overlooked a lot in the SMSF environment, or just super in general. I mean, tax rating. You know, if you've got money in CBUS or money in Oz Super, tax rate's the same. But yeah, I think if we've got the tax rate in the superannuation environment is 15%. When it comes to capital gains tax, if we've held the asset for longer than 12 months, and again, whether it's a property, whether it's shares in BHP, whatever the asset is, we get a 30% CGT discount. So our capital gains tax rate would go from 15% to 10%, or we wait till we retire. Where we've already retired and then we sell the assets, then we don't have to pay any capital gains tax, which is pretty
winning.
Yeah,
that is massive. Awesome. All right. We've got 10 minutes left. So break this myth for me, right? Self-managed super funds are way too expensive to run.
Yeah, I mean, simple myth to break. I mean, one, they define expensive. I think, the common misconception, people think, it's 8 to 10 grand to run an SMS every year, which is totally not. Generally speaking, like for example, for us, for the management, like the accounting, all the audits, all your asset renewal fees, your SMSF supervisory leverage, which every self-managed super fund has to pay, you're looking about, again, some variance in asset fees, but about 15, 50, 600 bucks a year. Most people, I mean, anyone who's got over 150 grand in super, they're probably paying more than that anyway. So they're just going, what am I actually paying now? What am I getting? And yeah, I think another benefit of the SMSF structure is, it doesn't matter how much you've got in there, the fees to run it are the same because the accounting work is exactly the same. So it's not like, if you've got money in an industry or retail fund, obviously they're charging a percentage of what you've got there, assets under management. So the more you have, the more you pay for effectively the same work. So yeah, I think it's in that structure, it's nice to have fees that are fixed. I think it makes it easier to plan, and yeah, it's whether you've got one property or properties or four properties, it's all the same.
Yeah, that's winning right there, I'll just say. Guys, thanks for joining us. If you haven't done it, we've got about 9 minutes left. Make sure you're following WT Capital. They drop a ton of information. If you are interested in having a chat with them, go up into my stand store. There is a free ebook there so you can work out whether it's right for you. AJ just asked that question. And then you can also book in with Matt and the team from WT Capital. I can tell you, if the sooner you do this, the sooner you'll go, oh my God, why didn't I do this years ago? No matter where you are, especially if you're a FIFO worker. I mean, from working 17 years in the industry, I wish I would have done this on 10 years. I know, and a lot of people are like, oh, but I don't have enough super. But there are so many different strategies that you can actually use to build up your super, like salary sacrificing and stuff like that. Matt, tell people about if they are thinking, I'm not earning enough or I don't have enough superannuation currently, what can they do?
Yeah, really good question. Again, so I mean, even just we've got in our sister business, WT Wealth, we own our own Australian Financial Services license. So we've got our planners there that can actually have a discussion, and provide some licensed advice around, even if you don't have enough yet, what is the strategy? How do we get there? Can we salary sacrifice more? What other options? Even reviewing, their current industry or retail super fund. A lot of people in these funds, and they're not even sure how what they're paying in fees per year. So start reviewing that, and there, 9 times out of 10, there are some easy wins that people can take. And as I've said before, I think for most people, super's like it's out of sight, out of mind. They don't think about it, and then when they look at it, they're like, oh, I'm probably paying more than I should there. So yeah, even if it's if they don't quite have enough now, very simply and easily, a plan can be put together to get them there and go, hey, these are the steps we take, and it's going to take 1 year, 2 years, whatever it is.
Yeah, definitely. And I mean, I think it's 30 grand that you can salary sacrifice into your account now, isn't it?
Yeah, absolutely. So that's the concessional cap has increased. It was 27,500 per year. Now it's $30,000 a year. Obviously, tax at the concessional rate of 15%. So again, you should max that. Any time you can, you should max that. I mean, that's just a huge win. I mean, that in itself, if you do that every year, I mean, that makes a massive difference because obviously, you're saving, paying, particularly, guys in the FIFO or guys and girls in the FIFO space. who are paying a lot of income tax. You want to sort of really sort of utilize that as best you can. It's going to ultimately result in putting more money in your pocket and less money paid in income tax.
God, yeah, 100%. And it wasn't until I was just like, I was always like, no, I'm not putting more money away into my super. And then it wasn't until I started earning, like paying 30-something% tax. I was like, what? Okay, so pay half of that and keep more money and build my super faster. Okay, it makes sense. So yeah, 100%. And what would you say? Who is for somebody watching right now? Who is the perfect person who you would 100% say, listen, come and have a chat with us. And then we'll show you exactly how you can retire with a ton of wealth, probably way more than what you'd be doing right now. Who's the perfect person that you'd like to speak to right now, Matt?
Yeah, look, I suppose we have clients in every single state in Australia, virtually every industry. So I mean, anyone who's working, ideally, and again, part of it is looking at ease of borrowing. If you're working full time, you've got regular income, sort of at least on 85, 90K a year, and would have upwards of 140, 150K in super. Then that's going to give you the ability to look at quite a good variety of properties. Again, we sort of specialize in acquiring properties, so that's going to give them a bit of choice. And I think looking at some of the results, or a lot of the results that we've seen, across multiple markets in Australia in the past couple of years, you could be in a vastly different, even in 12 to 24 months, you get a vastly different position than when you started. So yeah, I think it's at least worthy of consideration. And I think it's just looking at where you are now. Is what you're currently doing going to give you the quality of retirement that you really hope for? And if it isn't, then it always pays dividends to make a move earlier rather than leave it to the last minute.
Yeah, agreed, 100%. And I'd also say this is for somebody who wants to create huge amounts of wealth, but they're super lazy and they don't want to do much because, leaving your super where it is and doing absolutely nothing is pretty lazy. But actually being able to put a little bit of effort in and just, basically get you guys to do everything. And then next minute, oh, hey, have a look at this property. It's way under market. Do you want to buy it? We're going to make, 50K on going into buying this. Do you want it? Yeah. Okay, cool. Let's do that. You know what I mean? It's about, if somebody's out there watching and you want to make a ton of wealth and you don't want to do that much work and get these guys to do it for you, I would highly, highly recommend. The team has been absolutely phenomenal working with. So yeah. Thank you, Matt. And anything else? I've got about 3 minutes left. I am aware of your schedule and mine. So tell me, what is one last myth that you think is important for people to know about starting up a self-managed super fund, or opposed to just leaving their super there doing nothing?
Yeah, I think it's twofold. I mean, the first one, again, something that we still get almost every week. People say, "Oh, you can't buy a property in super." I'm like, well, you do it every single day, many times a day. So you definitely can. I suppose that'd be the first myth. And again, I think people just think it's over their head. They're like, oh, well, it's I don't understand, or I can't do it, or it's I'm not this for that. And it's invest in just one or two good relationships, have the right team around you, and then you can leverage their expertise. And that's ultimately how you get more out of your time and more out of your money. So I think, that would be a big misconception. People think just because they don't understand how to do one thing, find someone that does, and then lean on them and they'll do everything for you. And that's
right.
You should repeat that for a couple of years, and you do that for 10 years, and you'll have a completely different life.
Yeah, agreed. I just cannot believe I didn't find you guys earlier. So yeah, so all good. And I'm glad that you've started on the TikTok channel as well, because this is something I just cannot say to people, just do it. Just go and have a chat with the boys. It's not going to cost you anything except a bit of time, and then bang, next minute they're creating a plan which is going to get you to enable you to retire earlier. So guys, if you're watching right now, this is Matt from WT Capital. Follow his TikTok channel. They've got a ton of content to help get you not employed, sorry, that's me, to help you guys save as much money as you can and build wealth in your self-managed super fund. It is so much easier than what you think. If I can do it with the help of these guys, anybody can do it. I'll just say that. I'm Alana from Win-Win. Make sure you follow my channel. Matt, thank you so much. It's 10:59 where I am right now. Much appreciated. I will chuck this everywhere. Guys, there's a link in my Stan store. It is a free ebook. Go up there, download it. a little light reading for you, and there's a link where you can chat to Matt and the team and just basically say, make me rich so I can retire and not have to worry about getting $1,100 a fortnight or whatever it is that the government pension is paying. So that's what you want. Thanks for watching. Thank you, Matt. I'll let you go, and thank you for the team for moderating as well. So thanks, Matt.
But yeah.
Later.